few days ago, Mr. Lu, he had a YouTube live session and he talked about a powerful, simple crash buying system. So for those who don't know Mr. Lu, he's creating YouTube content for a while already, especially right after COVID period, right? I think there was a couple of market kind of like crashes or market dip. Right? He's the one that on his YouTube, on his Telegram group, he's guiding people into like crash buying. I think all this while, right, his so-called crash buying, right, is more like view-based, meaning that he will look at market dip and then he will study the economics and then he will give commentary. Then he will tell people when he deploy his dry powder, right? So I think there are many people actually follow his call one, meaning that people saw him bought into the market, buy the dip, they also follow. I think this is definitely true. And I think the more interesting part about this video is that he's not just talking about on high level, wait for market crash and then buy. It's not like that. He really come up with a strategy with specific drawdown numbers and specific allocations that he's going to deploy. So that's why I find it quite interesting, because once you have this kind of rule that you can formalize, right, then you can run all this what we call back testing, meaning that you just take the strategy and then you run through the historical period and then you just look at the result, whether it makes sense or not. So basically today I'm going to cover whether this crash buying system, whether it works or not, and everything will be based on data analysis and not so much about my own opinion. Just to give you all a bit of introductions, because if you don't know about this video, you don't know the content, it's a bit hard for you to follow. So I will give you a bit of intro, but I strongly encourage you to go to his 1M65 YouTube channel and then you click on the live section, right? And then I think the video is still there. You can click into it. I think this video is about 1 hour length. It's quite interesting because he really have an Excel model that try to simulate the actual buyings. So that's what he did now. So this is the Excel spreadsheet that he created. So you see that there's a button up and down here, right? This is when one click means that you move to next day, right? And then his strategy is summarized in this table here on the right hand side. So if you look at this, let me zoom it up for you. So basically his strategy is that if market drop 10%, right, then he will deploy 10% of his capital, and his capital is always start with 200k. So 10% of 200k is 20k. If he did 15%, right, then he will deploy 15%, meaning 30,000, and so on and so forth. So if really market drop by 30%, right, he will deploy all this money. In total, he would deploy 200,000. And all this dip, right, or also called drop, right, is what we call drawdown. Drawdown meaning that if you see market climb to a peak, right, and then from there it drops slightly, right, you always compare today's price versus the all-time high prices. So that's what we call drawdown. So you need to experience this drawdown, 10%, 15, 20, 25%, then only you buy. If there's no drawdown, right, and let's say from his starting point, right, no drawdown, let's say you can have drawdown of 2%, 5%, 8%, it doesn't hit this 10%, right, then he will just keep on holding cash. Basically, that's the strategy that he's trying to come up with. And quite interesting is that he really simulate, right, so he, for example, he give a date, right, starting with a date, and then he put key in the date, and then he just click next, and then if it hits the level, and then he will just record a buy transactions, and then he will put into his spreadsheet, and then he will calculate his P&L. But basically just look at out of that 200k, how much it will grow. So basically that's the strategy. And then let me give one example here. Okay, so because I need to study whether it works or not, I need to validate it, right? So I come up with my own data, and the data wise is quite simple. Basically we only need the S&P index, and then you can model his strategy, right? Say for example, if it dropped 10, 15, 20%, then you will buy, and these are the date of the purchase. In terms of the data that I have, right, I have a longer data. I pull up the data from 1981. So this is the longest one that I can get from investing.com. Of course, S&P 500 it is longer, but I think 1981 is quite long already. We have like 44 years of data. So similar to his strategy, start with 200k. So basically I try to mimic his strategy. Okay, so I can give one example just to make sure that my formula here, right, actually is the same as his one. So let's say I start from 2019, 29th of November, which is one of the example that Mr. Lu has provided. Okay, so based on this strategy here, right, you can see that, okay, my model here, because I don't do like manual things, right, I just, based on the formula, I just know that, okay, if on 2019 November 29th, right, let's say on that date, right, suddenly we're handed with 200,000. Following his strategy, right, I will just wait for the first 10% crash and then I will buy, right, and the first 10% crash right, happened on 27th of February 2020. So this is like a couple of months after the start date, meaning that you wait like about 3 months, right, then 10% drawdown, then you buy 10%. Then after that, on 9th of March, you buy another tranche with it, which is 15%, and so on and so forth. And then by 20th of March, right, you deploy all 200,000 already, because really the market drawdown, right, already exceeded 30%. So basically this is my formula here. So if you look at all these buy dates, right, they are the same as the one that provided by Mr. Lu. So basically this is the one that I screenshot. Okay, the top part, right, is I took it from his YouTube video. So you can see the date actually they're all matched, right? So 27th of February, here 27th of February, then 9th of March, 12th of March, and then 16th 16th of March. So basically, this is his strategy, and he just want to say that, okay, he started with 200,000, right? And if you deploy all your money, March 2020, right? Then after that, you just stay invested. You just do nothing, and then until today, right? You have 557,000 already. This is the total gains, right? Meaning that total gains is about 357,000 because your investment started with 200k. Okay, so basically this is the money that he earned. So he said, wow, his strategy really works. So okay, now that's the thing, right? If you want to say a strategy works or not, right? We need to compare against something. Let's say if we compare against just take that 200k, just put in bank account, or even hold that 200k in cash, meaning that you earn zero, right? If this number is not 557,000, it is just 201,000, right? You still gain 1,000. You will just say, okay, it works. Okay, I earn 1,000. I earn money. It still works. But should we compare against not investing? Just hold on to that 200,000. I think that's not a good comparison, because it is very hard to imagine someone who will just hold on cash for many years, right? Let's say if you start from 1981, you hold cash until now, of course you will lose out, right? So I just want to say that, okay, aside from this so-called crash buying strategy, right, I have another strategy, which is I just call it like just all in S&P 500. Okay, what's the meaning of just all in? So instead of like waiting for the market to drop 10, 15, 20%, right, I would, whenever I'm handed with that, pile of money, right, I would just all in 100% day one. No need to wait for all this threshold, straight away all in. But we want to compare these two strategy, right? We need to start from the same date, right? So let's say I just follow this date, 29th of November 2019, right? So based on his strategy, right, I will deploy on all this date, and then end up fast forward to today, I will have 557,000. If on 29th of November 2019, right, I just don't wait, I just all in, okay? Then right now today I will have 442,000. So you can see, right, 442 versus 557. My strategy lose out. Lose already. His one is really you wait for the market crash, then only you buy. It works, okay, based on his strategy here. Can we just based on this and conclude that this strategy is superior? So this is the question that I want to pose to you, right? Maybe you can pause here and just think for a while, like just look at this. Would you rather to have 557,000 or just 442,000? Of course, 557,000, right? You earn more by waiting for the crash, waiting for the dip for the crash, then only you buy. And when you buy at lower prices here, right, as compared to on 29th of November, right, of course you earn more, right? Very simple. But what's the problem of this strategy? Okay, so the problem of this strategy, right, is that whether it works or not, it really depends on your start date, right? But I think in Mr. Lu videos, right, he provided 3 dates as 3 starting point. Okay, the first one is this November 2019. Then after that you have a COVID crash, right? Then I think the second one he provided is 2021 29th of October. It is arbitrarily by Mr. Lu, but I just copy his date. So if you use this date, right, and then you start from 2021 October, right, you don't wait. You wait until 2022 February, May, June, September, when it hit all this drawdown level, right, then only you buy into the stock market, right? Then even that, right, the 30% never hit, right? So you just keep cash. Okay, even with that, right, you will have 327,000, which is more than my strategy, which is just all in on this start date here, 29th of October. Okay, so still win. Okay, this is the second date that he provided. And then the third one he provided is 29th of December 2017. And then he just wait until, you see, February, you hit the drawdown already, you buy. And then after that, the rest you will deploy in December 2018, and then the rest in March. Anyway, when you hit all this drawdown, you will deploy. Okay, so you successfully deploy all, and then today you have 591,000 instead of all in on 29th of December 2017. You will only have 519,000 on 3 dates, right? You won't. His strategy is superior strategy one as compared to mine. But the question is this, right? Are you sure that this kind of strategy, right, works on every day? Okay. So when I say I start from this 1981, right, it's not arbitrarily by me. It's just based on investing.com that all the data that I have, right, is from 1981 September, 1st of September. Okay. Imagine, right, let's say if I do this, right, you see, if you wait for market crash, right, you will wait until 1982 and then you successfully deploy 25%. Then the rest you have to wait like 5 years to deploy, because you need to wait until October 1987. Then only you are able to wait for that 30% drawdown. In between, right, 1982 to 87, right, you are actually holding cash. And when you are holding cash, let's say market is rallying or slowly climb up, right, you are losing out in terms of like you basically hold cash, and usually hold cash over the long term, they don't earn as much, right? So that's why you look at this investment account, right, you will end up with 11,447,000. But if you just all in on day one, right, you will have 11,287,000, which is more. Okay, but in terms of the average return, right, you get 9.5% based on his strategy, and then mine also 9.5%. Not that different. Okay, the difference here is only like 0.0%. Okay, but imagine if I run these things, right, not just one scenario. I don't cherry pick lah. Okay, basically I just run this. Okay, day one I run this, and then I look at the difference, 0%. Okay, then I repeat this for day 2. Okay, then I check again, it's 0%, and I keep repeating this, right, at day 3. I start from day 3, wait until today, and then see what is the percentage, right? You just do this, right, for all the data points. Then you look at the result, right, which what I want to show here. But before that, right, I'll just say that because based on all the data that I've just shown, right, let's say imagine that I just start from this specific date, right, instead of the dates provided by Mr. Lu, right? If you start from October 27, 2023, just another arbitrary date, right, it's actually cherry picking, okay? You actually following his strategy, you only deploy 25%. Then after that, you keep cash until today. So you end up having 244,000. But if you just all in on day 1, right, you will have 337,000. So this strategy, right, actually my strategy is better, okay? That's why I say you have to really run all the possible start date, right? Because we don't know when you would be handed that 200,000, right? You have to try all the dates, right? Then only you can compare these two strategy and you can tell these two strategy on average which one is better, right? So just now I say I repeat all this for all the dates, right? If you want to look at the results, right, it's actually the first one, right, by Mr. Lu's strategy. They will look something like this. This chart here, right, for every data point on this chart, right, say for example, I just choose a date on 1988, right? So this point here. So what it means is that if you are handed 200,000, right, and you follow his strategy, right, and then invest until today, what's the return that you will get? You will get 7.61%. So that's just one data point. And every date, right, you will just repeat the same thing and then you will just wait for the drawdown and then only you buy and then invest until today, you will have all this money, right? So the 3 data point provided by Mr. Lu, right, I try to circle it, they are around this region here. So say for example here, right, you get something like quite a high return, right? Let's say 14% and then here is even higher, right? So say for example, let's say this is one of the date that he provided, right? You see this 18%, this is the annualized return that you will get following his strategy. So you can see that, so that's the point that was picked by Mr. Lu. And then the third point is around here. So all these points, right, you notice that they are above 10% because S&P 500 over the long term, right, their returns is about like 10% each depending on your exact start date and exact end date. But you can see if you follow his strategy based on this chart here, right, you will end up more than 10%, which I mean based on his argument is that these 3 dates, right, it shows that it is superior, okay? So this is the line. Let's say if you follow my strategy, which is just all in on day 1 and then hold until today, right, you get this line here, right? And this line here, you can see they also depends on your start date. Say for example, let's say if your start date is around year 2000, right, then after that you just all in on day 1, right? And then we all know that from 2000 to 2010, right, you have 2 market crashes, right? So you actually just start at .com bubble and then you just hold until today, you will have much lower returns, which is around only 6%. But let's say if you start way earlier, right, in 1981, and of course you can get something close to 10%. And then of course if you start right after global financial crisis around 2009, right, you will get something like close to about 14%, right? So you have very different results comparing these two strategy. And what we need to do, right, is just you take his strategy minus my strategy and then you see whether it is above 0 or below 0. And that is the chart that I'm going to show you here. So this is Mr. Lu's strategy, crash buying, minus my all-in, just all-in strategy. You get something like this. So you notice, right, the 0%, right, is somewhere around here. Okay, this is the 0% here. And the 3 points that picked by Mr. Lu, right, they are better, which I just shown, right? I say that, okay, if you pick these 3 dates, the numbers is above 0% because his numbers is better than mine. Okay, so this 3 red line. And just I also provided some examples, right? Let's say if I buy around 2012, right? Let's say 2012 is you can just pick another, like one of the date, right? You pick one date here or you pick one date here, right? You will end up just getting a lot better result based on all in. I give another one example. So this is another example, right? Just to check whether our numbers is correct or not, right? So let's say if you start in June 2020, okay? You follow his strategy, right? You deploy on these 4 dates here and then you end up only with 328,000. But you just all in on day 1, right? You get 454,000. This is like, quite different. 9.2% versus 15.7%. Why? Because on this date here, you just buy, you already picked up the market before it rally, right? So you just all in here and then you just ride through all this instead of like wait the entire 2021. If you want to look at the difference, right? Just to show you the date just now, okay? That's the starting date, right? 2020 June here, right? You say I want to wait until 10%, 15%, 20% and 25%. My strategy is that day 1 here, you straight away buy already, okay? And then you just ride on the market up and then market down, you just ride on it until today. So that's the return that you get if you follow my all-in strategy. But if you wait for Mr. Lu's strategy, right? Basically, you are not deploying money for quite a while, you see, for about 1 year each year. And then after that, okay, market really crashed in 2022. Okay, all this, slow down in economics. Then you deploy here, you deploy here, you deploy here, and then you really hit 30%, right? So your strategy really works. You deploy here, right? So you buy here. But if you look at the chart here, right? Deploy here and here when there's market dip, right? Actually, this level here, right, is still higher than the start date here. That's why his crash buying strategy is worse off as compared to just buy on day 1 all in, right? So you can see that's the difference. Just to give you some idea. This is basically showing the drawdown here to illustrate that yes, although if you just based on his result here, and then you say that I only had 200,000, I follow my strategy, everything I just follow, I end up with 328,000. You earn 128,000, right? If you don't compare with anything else, you will say that okay, my strategy works. I earn 128,000 by waiting for market crash and then just buy on the dip and then just hold on to it, right? But someone else who just say that okay, I just know whenever I have the money, regardless of when I get the money, 200,000 on day one, I just lump sum on day one. That kind of like even a simpler strategy, right? You get something like 454,000 on this specific date. So that's why I say that it all depends on your start date. Different start date, you will have different results. So if you look at this chart here, right? Let's say if your start date is somewhere around here or here or here, right? Then wait for market crashes, right? Your result will be better. I think all these date, right, coincide with just the market peak before the market drop, okay? If you wait for market crash, of course it is better, right? But if your start date is the green circle here, here or somewhere around 1990, right? You want to wait for market crash, but it didn't happen, right? So you just day one lump sum a lot better. You get a much better result. And just for your information, if I just take an average of all these numbers, column C is strategy 1, column D is strategy 2, right? Strategy 1 is Mr. Lu crash buying, right? Let me just calculate for you quickly here. So average, okay? And then you just take his one minus mine. So actually just lump sum on day one, you get like 0.8% higher. And 0.8%, right? If you compound 0.8% for long enough, the difference is very, very big one, okay? So just for your information, so it can be very big. And secondly, right, even the data, right, that I have here, right, I just assume that I invest in S&P 500, okay? Basically, I just earn the price return, okay? Not even the dividend, because dividend data is a bit harder to get. I just don't bother to get it, okay? But if you keep cash, right, actually I take the 3 months T-bill just to simulate that, okay? Assuming that if you don't invest, you keep in cash, you will earn that 3 months US Treasury bill as your cash returns. So just to make sure that we all compare, to be fair to those who just hold on to cash, so that you get a little bit of yield, right? And for S&P 500, let's say if you include the dividend, right? And we all know that I think throughout history, right, depending on which period that you're looking at, if you look at the recent period, I think dividends is a lot lower, and earlier period it is actually higher. Even 1% take the dividend use of 1% across, right? Then you get close to 2% difference by just waiting for crash. It actually make your result worse off on average. So that's why I would say that sometimes, although all this crash buying strategy, right, it works on paper, right? And it based on the strategy that we just seen, right? It works if you just say that, okay, it works. I define it works by just having some positive returns, right? It sounds good, right? But actually, if you just compare against another simpler strategy, which is just all in on day one, right? Actually, all in on day one have better results on average. So that's the key point that I want to tell you. But with that said, right, I have to give some credit to Mr. Du, because not everyone is like him trying to educate people on investing on like almost every day. I saw him, his frequency publishing videos is so high, right? So I have to give some credit to him for coming up with this Excel spreadsheet just to help people to learn about all this investment, right? And sometimes even though I say that my strategy 2, which is just all in on day one, is better than his strategy of crash buying, right? But I do feel that, let's say from emotional point of view, right? Let's say if you condition yourself to say that, okay, I only buy when market is crashing, right? You are actually conditioning yourself to take advantage of market crashes instead of panic during market crashes. Because let's say when market experience some sort of drawdown, there's some sort of crisis, right? You are, emotionally we feel very a bit, how to say, we worry about our portfolio. And when you feel worried, right, you will tend to want to do something regardless of what it is. You just feel like, okay, I need to act, right? So I think that is perfectly normal. So anyone who have experienced all these market crashes, right, they will know that, okay, whenever market have some sort of crisis, we get worried and we just want to do something. And if you don't have a framework, right, you just say, okay, I lump sum on day one, right? And then suddenly market is like having a crisis, right? Then your next panic action could be just you want to sell. You want to park in cash, you want to wait for the crisis to be over, then only you start to think about whether it come back to the market again. That is the worst kind of investing, because when market crashes, right, what we wanted to do is that if you have money, you want to buy more, because those are the period where you can buy at a much affordable level. So I 100% agree with Mr. Lu on this. That's why when he come up with all these tools, right, to help people, instead of like thinking, should I panic? Now you are thinking about, oh, I have a pile of cash which saved out already. Now I can deploy. You condition yourself to do the right thing during market crisis, which I appreciate. I think that is the right thing to do. It's just that me coming from like a nerdy kind of perspective, right? And I just think of like, if we try out all this period instead of like cherry picking 1 or 2, 3 data points, right? Does this strategy really work? That's the thing that I want to try out. So that's why, even though I feel that this just all in is better on average. But if you think of like investing, not just everything based on logic, everything just based on quantitative, right? You just think of it from emotional point of view. I do think that his strategy is superior one. So this one I really need to give credit to Mr. Lu. All right, I think just as a closing, right? Just want to tell you like, okay, even though I say that strategy 2 is better, we also need to understand why it is better. Okay, so a simpler explanation that I can give, right, is that when you compare strategy 1 crash buying versus strategy 2, right, I think the most obvious difference is that strategy 2, right, we don't wait one, we just deploy. Okay, you just maximize your time in the market, and by that, right, that alone is enough to push out your return rate, because market, right, like S&P 500, right, the longer you stay in the market, the more return that you can make, because all this, like the entire market, right, is made up of all these companies, and many of these companies, they are very profitable. Even during market crisis, right, they are, if you look at their share price, right, the share price drop, but if you look at the business, right, the fundamentals, sometimes they have a bit of dip, right, but I can't imagine, let's say the entire market, right, suddenly the earnings, all the dollars, all the earnings all gone. Usually it's not like this one. Even the earnings dip by 10%, 20%, right, the market already freaked out, meaning that earnings, right, the fundamentals, right, they are usually quite resilient one. Yes, it could dip 5, 10, 15%, but you don't see the earnings just dip by 50%, 80%. That won't happen, right? That's why if you stay long enough in the market, right, or what we call the equity risk premium, right, the longer you stay in the market, right, the more returns you are going to make. And my strategy by construction, right, I max up the time in the market. But for Mr. Lu crash buying strategy, right, he just, there's a portion where, let's say after he deployed, then he just max up the time in the market. But the period before he bought into market, right, that was the period he stayed with cash, right? That's the part that dragged his return to be lower. So, or so-called cash drag now. So that's the terms. So just to, as a reminder, right, this is pulling from Jeremy Siegel's book, Stocks for the Long Run. So you look at in the past 200 years, right, if you invest in stock market, right, stock market is the one that give you very, very high returns as compared to cash. If you hold cash after accounted for inflation, you are losing out. So I think that's the most important thing to remember. But holding to stock, although it works over the long run, but the short term, right, whenever there's a bit of like, market crisis, right, market just dip by 10, 15, 20%, you see people freaked out, right? I think that's the part that not many people are able to withstand. They tend to panic. And when they panic, they sell out, and then they will result in all this permanent loss, right? Those are the costs that paid by those who just, not able to hold. So I think that's all about my sharing today. Thanks for watching. So I should have put this in my main sharing deck, right? Far more money has been lost by investor preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. So I think this is a great quote by Peter Lynch. Basically what he trying to say is that don't time the market, just all in. Just all in is like you maximize your time in the market, and then by that, right, you will have a better results. Don't think about too much about like timing the market. So I think this is definitely a good quote by Peter Lynch. 祝大家新年快乐啊! Happy Chinese New Year, horse year. Hope everyone portfolio what big. Okay, thank you so much. See you in the next one.